In this final video for Chapter 11, which is the last chapter in Intermediate Accounting 1, we are going to talk about expenditures after acquisition. So what happens if you already have a capital asset and then you make more expenditures to go along with that? There are two options as to what to do with those expenditures. You may capitalize that or you may expense it. Capitalizing it, meaning you're going to add it to the asset on the balance sheet, and now the value that you are going to be depreciating will be even higher. Or expense it, meaning you're going to put it directly on the income statement in the period that you incurred that expense. So what is the difference between the two? The capitalizing comes if you are increasing the asset's book value or creating a new asset. So we're going to dig into this further. And expensing it is if you're just maintaining the normal level of the asset already. You're not adding to it. You're not increasing the future benefit of the asset. You're just maintaining it in order to keep it running the way that it should. So increasing of future benefits. So extending the useful life would be an increase of future benefits, and that would mean that you would capitalize it. You are extending the useful life. If you increase the asset's productive capability or capacity, so that is going to add to the asset's ability to increase our benefits financially. We are going to be more efficient with our machine or with our vehicle or something along those lines. Then we're going to capitalize that expenditure. Improving the efficiency or reducing operating costs. So, okay, we're helping this machine to run better, we're helping this vehicle to run better, whatever this asset may be. And if we can help it decrease operating costs, that can also be a cause for capitalizing that asset. Enhancing the quality of the output would also count as something that's going to give us more future benefit, and we would capitalize that expenditure. Or adding a whole new functionality. So we've added something to this asset that it couldn't even do before, and now it's going to increase the future benefits in a whole new way. So those would all be capitalizable expenditures when it comes to after you have already acquired the asset. So we also have material thresholds for capitalization, because you have to think companies are going to need to set a material threshold. So think of materiality as a number that is going to make a difference in a decision. So for you, if you dropped a dollar bill, would you, and you realize you did it like a mile ago, would you go back and pick it up? No. Would you go back and pick up $100 bill? Probably. I know I would. Now, what about Elon Musk? If he dropped a $100 bill a mile ago, would he go back and pick it up? No, it's not material to him. So while $100 is material to us and it's enough that we would go back and try to find it in most cases, Elon Musk, it's not a material amount to him. So each company is going to differ as well. If it's a small company, a material amount may be a very small amount. Where if it's a huge company like Apple, then their materiality number would be very different because they're working on a much larger scale in general. So the dollar amount that a company sets to decide whether to capitalize an expenditure as an asset or expense it right away. So here we're talking about materiality, a number that's set for a company. And this is just saying, okay, maybe we purchase something like a trash can, and sure, it's going to bring us value for more than a year, but it was 25 bucks. We're not going to put that on the balance sheet and depreciate it. And it's below that materiality threshold. So the example here, if a company sets a $5,000 capitalization threshold, a $7,000 machine repair that extends its life would be capitalized, but a $500 repair would just be expensed. And I've worked at companies where $500 was the threshold. Anything below $500, we just expense it out. If it's above $500, then we'll actually record it on the balance sheet. So every company is going to be different. So just prepare for that as you go in the working world. Then we have repairs and maintenance. This is needed to just maintain the given level of benefits. We got to go in there and we got to tweak some things on the machine. We got to do an oil change on the vehicle. This is not something that's going to prolong the future benefits beyond what we thought it would be in the first place. It's just going to keep it running the way that it should. Does not increase the future benefits. And if that's the case, it should be expensed in the period that we incurred that expense. So those are repairs and maintenance. It just goes directly on the income statement. Let's test our knowledge. Dirt Rich Industries operates a fleet of delivery vehicles. The company spends $12,000 to install a refrigeration unit in one of its trucks so it can deliver perishable goods. Don't you want to buy perishable goods from a company called Dirt Rich Industries? Should this cost be capitalized or expensed? Okay, it's $12,000. I don't know exactly what their materiality threshold is, but I'm going to guess it's over $12,000. And they're installing a refrigeration unit into one of their trucks. So this is going to add a whole new functionality to a truck. This is not just maintaining the regular level of, performance we expect from the truck. This is adding a whole new thing. So this would actually be capitalized. It adds new functionality. I'm not going to read all of that. It produces future economic benefits beyond this current period and beyond what we ever even expected. And if the company has a capitalization threshold, the $12,000 amount clearly exceeds that, even though it doesn't tell us exactly what that is. The $12,000 would surely be higher than that. So we would go ahead and capitalize this asset. Dirt Rich Industries owns a piece of manufacturing equipment. During the year, the company made the following expenditures. They paid $800 for routine lubrication and cleaning to keep the machine running smoothly. Would that be something that we expense in the same accounting period, or would we capitalize that? We'll come back to it. They also spent $18,000 to upgrade the machine with a new control system that allows it to produce goods twice as fast. So we're being more efficient. So what do you think? The $800, $18,000, what are they doing with those? So if you said that the $800 for just the regular maintenance should be expensed, then great job. That we're going to expense routine maintenance. It just keeps the machine working as we expect it. The $18,000 is a control system upgrade. We're going to capitalize that. That is going to improve the machine's productivity, provide benefits beyond the current fiscal year, and we need to go ahead and put that onto the machine on the balance sheet and start depreciating it over the rest of its life. So hopefully that makes sense with what to do post-acquisition when we are going to have more expenditures for an asset. Now let's look at some optional methods to go along with those, to go along with some improvements. So substitutions. If we do an improvement on an asset, these are 3 different ways that we could account for. Substitution, we are going to dispose of the old component and we're going to have a new component. So we are actually getting rid of one and substituting it with another. Capitalization of new costs. The cost of the improvement is to the related asset. The original cost and accumulated depreciation are not removed. We are just going to add this to that asset. Or reduction of accumulated depreciation is also an option. And we're going to see examples of all of this, so don't panic if you're like, what are we talking about? The asset account is left unaltered, so the actual asset on the balance sheet, but its related accumulated depreciation is going to decrease. The book value is the same as in capitalization of the cost method, of the one right before, and the accumulated depreciation amounts differ under these 2 methods. So let's jump into looking at the 3 methods, and we're going to use this same example in all 3 methods. So 2025, Dirt Rich Industries replaced their heating system in one of their warehouses. The cost of the old system was $300,000. It was included in the cost of the building. However, the company had separately depreciated the heating system. Depreciation recorded up to the date of the replacement totaled $240,000. The old system was removed and a new system installed at a cost of $350,000, which was paid in cash. Scrap materials from the old system were sold for $15,000. So if we're going to use the substitution method, this is where they dispose of the old component. We are going to debit cash for the $15,000 that they sold it for the scrap. We are going to decrease the accumulated depreciation by the whole $240,000. They got rid of it. We're going to get rid of the heating system that we showed, or it may show as the building itself, but we're going to remove that. So we'll credit that asset for $300,000, and then the difference, the $45,000, will be a loss. All right, and if we did that, we would also include the acquisition of the new component within the same thing. So then we would show the new component, which we would either put as the heating system or record as an increase to the building itself for the $350,000, and we'd be paying the cash for the $350,000 as it showed here. So what if we did this under the capitalization of new cost? So if we did that, we would show the heating system would just be the difference between the 350 that we had, that the new system was, minus the 15,000 of cash that we got. So we'd just be adding the heating system of 335,000 in this case if we were capitalizing the new cost. Then if we were doing the third method, the reduction of accumulated depreciation, we would take that difference and we would simply show it decreasing the accumulated depreciation. Remember, that's a contra asset, so it has a normal credit balance. We would decrease it by the 350 for the new asset minus the 15,000 of scrap, the money that we got, and we would show cash leaving for that difference. And so we're just decreasing the actual accumulated depreciation in this situation. So we could treat it any of these ways, whether it was the substitution, the capitalization, or the reduction of accumulated depreciation. So we kind of went through those fast. If you need to rewind that, slow it down, feel free to do that as well. So last couple things we're going to talk about, just real short, last couple slides. Rearrangements. So this is expenditures that are incurred to move, reconfigure, or reorganize existing assets so they can be used more efficiently. So we are actually going to have to pay to be moving things. So this is where it's a significant move. It's not just like, hey, we're going to spend the next 20 minutes to move some things around. But, maybe they're having to shut down production for a while. Maybe they're having to pay a crew to come in and move things. Maybe they're having to get a truck to move things from one location to another, but there are costs incurred with that. So moving production equipment to a different location, reconfiguring the factory floor, but again, not just a 20-minute thing, something where they're actually shutting it down for a while and it's costing them. Relocating machinery to improve workflow. So any of those things would be good examples. The way that we treat this is we would capitalize those costs if they clearly increase future benefits. So if any of those things are going to increase our future benefits financially, then we can capitalize that. So we can add that to the cost of the asset. Or we would expense it if it's immaterial or the future benefits uncertain. So yeah, we're doing this, but it's not costing us much. Or, again, if it's uncertain what benefit this is going to bring us, but we just felt like it would work better, then we would just expense any costs that we incurred for this rearrangement. And finally, last part of chapter 11 here, defending litigation. So if there are legal fees and costs relating to defending litigation, they are treated differently depending on the outcome of the case. So here we're talking about something like we are defending, went too far. We're defending something like our patent. So somebody's attacking our patent. So we have to go to court about this and we incur fees. So the fees are going to be treated differently depending on whether we win or lose. So if the company wins, it is successfully defended, the costs are capitalized as part of that related asset. So if it's a patent, we will actually debit the patent for the cost of litigation if we win, because this is going to bring us future benefit because we had to incur these costs in order to defend that and keep it going. If the company loses and it was unsuccessful, then they are going to be expensed whenever they're incurred. So we can't really debit the asset in this case, because if they lose it, they may be losing the asset as well, but it did not help us to prolong this asset itself. Well, that is the end of chapter 11. And if you're in my class, that's the end of Intermediate Accounting 1. So great job. That is a huge feat. And with that said, you still have 10 chapters ahead of you for Intermediate Accounting 2. But make sure you stay tuned. I am going to continue to have videos walking through each of these chapters in hopefully basic ways that help you to understand the content. So excellent job.